Welcome back to the Property Frontline. Today I'm here again with Scott Hoaxang for our Market Watch update covering data to January 2025. We'd also like to thank all of the people who viewed our last episode. So a bit of a record for us. We got over 450 views. So if you haven't watched that episode, it was our market forecast for 2025. Take a look at it. But today we're going to be covering, as I said, data for January 2025. So what has the market done up until the 31st of January? And we are also going to cover off the rental market. So a snapshot of what's been happening and some of the other factors that actually influence that data. So today is the 12th of February. The data that we're looking at is the data that we usually cover, which is sales performance for houses from CoreLogic, SQM Research and PropTrack. So we combine all of those main reliable data sources and look at how each of them has recorded what's happened to date. So Scott, would you like to take us through Sydney, Melbourne, Brisbane and Adelaide?
Sure, Deborah. Thanks for the handover. Gee, I love our super chart here with all the data sources all in one place and color coded too. So getting very snazzy here. Sydney house prices, seeing a lot of red for the month of January. CoreLogic had us down 0.4%. The SQM asking price data index down 0.2%. And PropTrack, which does tend to have lower increases and decreases, a minus 0.1. So certainly seeing some weakness in the Sydney market. It is on a limited number of sales, as we talked about in the past, because we've got a January holiday season mixed in here. On to Melbourne, similar story actually. CoreLogic were down minus 0.5%. A deeper fall in that SQM asking price data, down minus 0.7. PropTrack was down 0.2. So we've got our two capital cities with falling prices. Switching gears over to Brisbane, up 0.3 with CoreLogic, down a bit with SQM, 0.2, and relatively flat with PropTrack, up 0.1. And I'll do Adelaide here as well. Certainly two strong monthly performances here with CoreLogic having Adelaide up 0.7% and really a bit of an outlier here with that SQM data up 1.5% for the month for little old Adelaide. Something may be going on there. Maybe Lewis is picking up some sort of trend there. But then PropTrack has it pretty well flat, down 0.1%. So, a bit of a mixed bag across those four cities. I'll sort of maybe hand it over to Debra here, and she can take us through the rest of our capital cities.
Yeah, okay. And once again, I think it is worthwhile mentioning that we are looking at very limited numbers, but we can see a clear trend. It's almost like buyers and probably sellers are like putting a pause on their activity due to potential RBA changes, which we'll cover later on in our session. But looking at Perth, so CoreLogic has Perth performance at up 3%, SQM asking prices. So SQM, those asking prices are kind of like a forward look at what vendors are saying about what they think what they want for their properties. And then PropTrack has zero change. Hobart down 0.2, SQM Hobart more confident, and I think it's just a little bit of that overflow of people running out of Victoria. So they're scampering from Victoria up to Queensland, also to Adelaide, and now a little bit to Hobart. Anyway, so Hobart, yeah, and then PropTrack has Hobart down 0.6. Darwin has CoreLogic actual sales up 0.6. SQM has asking prices up 2%, and PropTrack has sales saying they were down 2%. Canberra down. CoreLogic has it down by 4%. SQM has asking prices down 1.2%, and PropTrack no change. So the other thing, and this is what I've always said about Canberra, number one, it's not Torrens title there, so it's the 99-year Crown land lease, so I don't like to buy in Canberra. And but the other thing is that with the federal election, they're talking about a massive layoff of government employees in Canberra, which will massively impact the prices there. So let's skip the national because it's much too high level, really. So Scott, would you like to take us through the speculation about the interest rate changes, because this is obviously the big topic in relation to property at the moment. So
Sure. I think we probably are all aware there's an RBA meeting coming up on February 17th and 18th. So that Tuesday, we're expecting to get some pretty significant news on interest rates. What we like to do is look at what the markets are forecasting in terms of a change in the cash rate. And those financial markets are projecting there's a 95% chance of a 0.25% cut in the cash rate. So it's probably worth tuning in and watching your news on that day. The markets moved to that point after the inflation report we got from the ABS back on January 29, for people that remember that one. All across the news, inflation was at 0.2% for the month. Gee, that sounds like a great number. 2.4% for the year. It all sounded very rosy. There were a few bubbles in there. Some things were sort of still going up, and the government had provided some rebates that were driving down that rate of inflation. But really from that point, we did see most of the major banks, now all the major banks, Louis at SQM and several other leading names out there, have moved their dials toward expecting that rate cut to happen. And we've got a second chart. I love this one just because I'm a data junkie. It shows what this is the ASX 30-day interbank rate cash rates futures. What does that mean? There's a bunch of bonds being traded out there by traders of different maturity rates, and they can calculate based on those rental yields on those, based on those interest rates on those bonds, what that implies they think the RBA cash rate will be over time. So this shows you what the market is betting. Those traders are all betting that the cash rate is going to drop one tick, 0.25% down in March. If you sort of scroll over there, Deborah, you'll see that implied yield drop down to 4.1. And then you can move over month by month and you can see about when the next rate cut would come in. So they're expecting second rate cut by June, potentially another one by the end of the year. So most are projecting 3 to 4 rate cuts in the next 12 months, maybe going out toward 18 months. That will provide quite a lot of relief out there, to stressed home buyers out there, certainly property investors with large portfolios with a lot of mortgage and a lot of interest. But it does not get us back to where we were pre-COVID. So it's a really kind of positive news here in the short term, but I think quite a bit of uncertainty for us longer term. in terms of where we're going to end up. I think everybody should be really looking at their portfolio and future purchases and really focusing on their cash flow, because
Yeah.
we don't want to be running any numbers ever saying we're going to see mortgage rates back down in the 2s and 3s. That's going to be
No.
a story we'll probably be telling our kids and
Mhm.
grandkids. Probably looking more like those long-term mortgage rates are going to settle really around 5% on houses.
Yeah. Yeah. Because even though it says here the implied yield is 3.5, there's always like a little bit of a buffer from the banks, isn't there?
The banks need to make a few crumbs on those loans, yes.
Certainly, CBA does after their like $5 billion
Crumbs.
profit. Yeah, all right. So, so Scott mentioned the focusing on cash flow and yield, which brings up our focus today, which is the rental market update. And just to give you a little bit of background, as we've mentioned over the past couple of months, there is a sell-off, particularly by investors in Victoria, and there's data that shows that there's been about 20,000 properties sold, or a decrease in rental properties over the last 18 months. So this is where investors have sold off, and it's highly likely that homeowners have purchased those properties. Now, there is a continued sell-off, but it is particularly for apartments that we're seeing a lot of it. And so a lot of this is driven not only by costs, but also because capital growth in the capital cities has really dried up. So in Sydney, we only saw a 0.8% capital increase in capital growth last year. Units, though, not houses, while Melbourne fell by 3%, but by contrast, Brisbane increased by 16%, Adelaide 16, nearly 17, and Perth up by 22, which is amazing. Now, slowing demand has pushed Melbourne rents lower, and also starting to really impact Sydney rents. But we'll talk in more detail about that next. And of course, as we keep saying, it's really a structural change in ownership of properties in Victoria due to the increased amount of taxes, the repellent political environment. So the government is not encouraging investment in property, or not encouraging what am I trying to say here? I'm going to have to start again. That'll be hard to cut. Anyway, so, and this last point here, so like we've said over the last couple of months, there's a structural change going on in Victoria where the sell-off is driven by the changes made by the state government in taxation, so really increasing taxation and making it harder for property owners to rent their properties out. And what else? Yeah, so some owners are really just trying to cut their losses, so they're actually selling at a loss. But of course, while a lot of people are selling, once it reaches a certain amount, a certain price point, there are a lot of buyers just keeping their eye on that market. And once it reaches like a really nice balance, we expect people will start to jump in. Of course, I have my opinion about buying there, but really it's up to every individual. We'll have different needs and drivers. So let's talk about what's happening. So Scott, can you take us through this chart which is the rents for houses across the country.
Sure, Deborah. We've got some annual rental price growth data here from CoreLogic across the capital cities. So our curves show what's been the rental growth in that market over the last 12 months. So we look at Perth, for instance, which is currently 7.4%. But if we went back, 12 months ago, that was running over 12%.
Mm.
So we're really seeing very high rates of rental price growth in a fast market like Perth, really falling dramatically now. It does not mean rents are falling, although they might at some point, but it means the rate of increase is falling a lot. So that 12-month figure goes down. Really, it's a pretty consistent story with most of the cities in there. They've had sort of spikes up in the past. That annual rate is falling. So we've got Hobart now, last 12 months, rents are up 5.5%. Adelaide's up 5.4%. And then really the other capital cities are really at the inflation rate, or are lower. Melbourne 3.5%, Brisbane up 2.9%. Just trying to see if there's any other lines in there we want to highlight at all.
So an offline conversation. So we're saying that over the last 12 months, Hobart rents have gone up 5.5%.
Yes, but after falling 12 months ago, rents were actually not only falling, but they had fallen over a 12-month period.
Yeah, I guess the other point to make here is that the big peak in the increase in rents was once the pandemic had really started to take hold, and then things did drop. So, overall, there is a bit of a moderating effect. So I'll look after the annual change in rents for units. So we're seeing a similar pattern here, where we're starting to see that downward trend, particularly in places like Sydney. We're even seeing there was a big drop off in Brisbane. And really Adelaide is the only one that is sort of had a consistent or starting to flatten out. Anything else that you would like to point out from a unit perspective in rents, Scott?
Just it looks like a story of stabilization, that not a lot of growth in the last 12 months, but we'll dig into some of the tighter stuff that shows what's been happening most recently.
Yeah, okay. So, over to you to talk about the annual change.
So this is actually just one more cut at that. Rather than capital cities, we've also got data that shows how the regions have done versus those capital cities. And there is a story here, if you follow that turquoise line, that's our regional increase in rents over the last 12 months. They had their large spike back into COVID in that 2021-22 timeframe. That was when everybody was allowed to work from home, and there was an exodus of people out of our cities. Rents then declined there as people returned to the cities, and actually seemed to have bottomed. Not bottomed, but the rate of growth has seemed to have bottomed, and we're starting to see some signs of growing rents in the regions. The capital cities took off a bit later, so we were now going back to offices. We saw that surge in rents in our capital cities, but that already has kind of come back quite a lot over the past 12 months. At a much lower rate now.
Yeah.
Just sort of a little interesting factoid here for people that work from home in this country. 36.3% of employed people typically work from home right now. Now, it was really high during COVID. I mean, they let everybody work from home back then. But even before COVID, 32% of people in this country were working from home a large portion of the time.
Wow, I didn't know that.
Thought it was an absolutely shocking figure. I guess it's just a sign of a lot of professionals and self-employed people that can work where they want. but it really does kind of demonstrate how people can live out in the regions,
Yeah,
still make that big capital city money
yeah,
that people want to make.
yeah. Um, yeah, and I wonder what that would be like comparing that to other countries. That, yeah, maybe
Uh,
we should look at that
yeah,
in
maybe
another session.
put that on the list. Work from home.
Yeah,
Australia, the country where you can work from home.
or Bali. Yeah.
Bali.
Yep. Okay. All right. So back to our data. Yeah. So really, what we're seeing is that rents have come back, and so the noise that the media is making about, how, like sure, it rents are more expensive than they were, but at least it's starting to moderate. Um, but the only thing that's really going to make a really good dent on uh, on rental prices is supply. So we do keep our eye on this data. We've mentioned it before, but to actually meet the government's challenge of building 1.2 million dwellings by, I think it was 2029, we need to be building around about 20,000 dwellings per month. And so to get that figure and to see where we're up to, you actually need to add these two lines together. So around about 10,000 were approved in November 24, and that was for houses. And then for units, you can see it has really dropped off because of the expense and a lot of the other limitations that builders have to actually building apartments. We really need to get this number up. But yeah, so we're down to about 6,000 in November 24. So you add those two together, that's about 16,000. And so we're just falling further and further behind of demand. And that's like pretend demand. Like, who decided that 1.2 was what we needed? When the government did put that number out, that was before we had something like 700,000 people who came in December, or in the 24, 23, 24 financial year. And then I think it was something like 500,000 last year. So, well, not that it's finished, but like it's unrealistic to expect that we're actually meeting housing demand. But anyway,
It gives me a bit of confidence, though. Look, as an investor owning properties and for our clients going out buying, we are always worried about getting into markets and having an oversupply,
yeah,
or falling rents or prices that are falling. And we're just looking at data here that says we are years away from having enough properties to house all the people that want to live in this country. It can always
yeah,
change a couple of years down the road. And I still hear people out there, giving that old house price crash story I've heard for, the past 20 years, that a big house price crash is just around the corner.
mm,
But when you look at the supply and demand numbers, we just don't see anything that could cause that.
no, no, we don't, unfortunately. Well, not that we want, prices to crash, but it is a problem that we need more dwellings.
Yes.
Anyway, alrighty. So that is it for us. Thank you very much for watching. Next time, we'll be covering the absolutely delicious topic of land tax and why it's important for you to understand it, the impacts it will have on your ownership, and why and how you can check your land tax implications before you purchase. Thus, there'll be so much more.
I don't want to get any surprises there, let me tell you.
No,
nothing quite like getting a multi-thousand-dollar land tax bill after you've already made a purchase.
no. No, you don't. So, yes, thanks so much, Scott. And thanks to everyone for listening. And if you would like to know when our next episode drops, make sure you subscribe. If you would like to speak to Scott or myself, our contact details will be in the description below. Send us a question if there's a topic that you would like us to cover. Okay, alrighty. Until next time. Bye.